Hello everyone, and welcome to Alternative Design's presentation of the power of active asset allocation. I'm Tim Harding, Chief Marketing Officer for Alternative Design, and I'd like to welcome you to today's presentation. Thanks for joining us once again. We're off to a pretty good start this month, a couple of weeks left in this offering period, so I know there's a lot of business cooking out there, even though it's summer. It's really kind of amazing. I think the uniqueness of our product line is what keeps the interest percolating, where other product lines tend to tail off in the summer because of vacation and kids out of school and all that stuff. We're actually doing pretty good. So if you're not promoting the Market Link CD right now, I think you're missing a unique opportunity. Today's presentation is on active asset allocation. And when I talk about active asset allocation or just asset allocation in general, a lot of people think of a different word. They think of diversification, and they think if you've got one, you've got the other. And the reality is you don't. There is a difference between diversification and asset allocation. Diversification means not having all your eggs in one basket. And we all know that. We learned that way back in high school. But asset allocation means not having only eggs. It means having other resources that you can turn to. And I've used this example before, but imagine that you're a street vendor in New York City, and you have a cart there where you can sell just about anything you want, but you've decided to sell sunglasses. Well, you could diversify into several different styles and several different brands of sunglasses, but the reality is, if it happens to rain one day, you're very unlikely to make any sunglass sales. So if you want to not just diversify into different styles and different brands of sunglasses, you might want to allocate your assets differently and offer not only sunglasses, but also umbrellas. Because sooner or later, it's going to rain. And on those sunny days, you may do very well selling sunglasses. But on those rainy days, instead of having everything fall off a cliff and you go home empty-handed, having those umbrellas as one of your assets to sell means you'll be turning a profit on those days as well. So asset allocation is spreading your resources, spreading your investment dollars over different asset classes, different types of investments that react differently under the same economic circumstances, especially asset classes that have what's called an inverse correlation with each other. In other words, when one goes down, the other one goes up. When one goes up, the other one goes, and vice versa, so that you get a steady, reasonable rate of return instead of riding that roller coaster that we talk about so often. Now, the interesting thing about true asset allocation is study after study has shown that over 90% of a portfolio's total return is determined by the asset classes held in that portfolio. Not by market timing, not by money managers, but by the different types of assets that are held in that portfolio. Asset allocation is critical to successful investing. Now, most people think asset allocation means having some stocks and some bonds. But folks, those are only two of several asset classes. Now, your clients and your prospects probably have significant exposure to stocks and bonds already, even if they aren't directly in the market. I mean, think about it. They probably have a 401k where they've got stock and or bond exposure. If you've sold them a fixed indexed annuity, they've got stock and bond exposure through the index, but the underlying government bonds as well. Most people have some stock and bond exposure, but they don't have exposure to other asset classes. That's why we were so excited a couple of years ago when we were able to bring on commodities-linked, market-linked CDs so that you'd have an opportunity to do some true asset allocating with your client base using an FDIC insured, principal protected, and guaranteed product. Well, one of the responses in the financial services arena in the past several decades to this issue of asset allocation has been indexing. linking to a broad-based index like the S&P 500. And people were clamoring for this some time ago. The loudest, most vocal member of the financial community, we all know, was Jack Bogle. And Jack was the founder of Vanguard and CEO for many years. Jack's philosophy was simply this: no money manager consistently beats the overall market. Therefore, the best strategy for an investor would be to invest broadly across the entire market as represented by, say, the S&P 500, and let the market do its thing. Hence, index-linked mutual funds and now, of course, index-linked products of various types. Now, indexing has clear advantages, and I've talked about these before. I'm a big fan of indexing as a strategy. It has broad exposure to the marketplace. So you've achieved what Jack Bogle wanted, which was to have be an investment that was representative of the market as a whole. Costs very little in the way of management fees because you're not paying a money manager to make decisions that probably aren't going to be correct a significant amount of the time anyway. And there's no management risk. Nominal fees, no management risk, and broad exposure to the general marketplace. But this strategy has some disadvantages. You are subject to whatever the market decides to do, whether it decides to go up or go down, and it's going to do both. You're going to go along for the ride. You don't have the ability to react to negative things impacting the marketplace. You don't have the ability to capitalize on opportunities that might come across because of changes in economic conditions. There is, in essence, then, no strategy. It is a passive way of investing. Indexing, in the traditional sense, to the S&P 500 or a similar index, is passive. Oh, and by the way, the vast majority of the indexes or indices that you come across or that products linked to today are still just a single asset class. It's all eggs. You may have broad-based representation across the full marketplace, but you're still talking about, in most cases, the stock market. And you're going to go wherever that market takes you. It's a passive strategy. I've said it before. It's like getting on a raft and floating down the Mississippi River. You're going to go wherever the current takes you, just like Tom and Huck. No choice. You never hear about somebody floating a raft up the river, even when it's advantageous to do so, because you have to go with the current. You have to go with the flow. You don't have the opportunity to make a U-turn. The only opportunity you have is to get off the raft wherever it's taking you. And I know a little bit about rafts because I grew up in Hannibal, Missouri, and right on the Mississippi River, home of Tom Sawyer and Huck Finn. And in reality, my great-grandfather worked for a logging company, and they rode log rafts and herded logs down the Mississippi River from Wisconsin. And one day he got to Hannibal, Missouri, decided to get off, and that's where my entire family is from, thanks to that log raft trip down the Mississippi River from Wisconsin. My argument today is that you have an opportunity with a unique product, a market-linked CD, that will allow you to capitalize on the deficiencies in traditional indexing. We have a product that links to multiple asset classes. So once again, what you've done is not just diversify across different types of stocks, different economic sectors. You're able to allocate assets over several different asset classes. Now, the traditional, asset allocation models are traditionally stocks and bonds. You can see some suggested allocation methodologies here. They diversify over large cap stocks, mid cap stocks, small cap stocks, some international stocks, some emerging market stocks, and then we'll throw in some bonds. Well, in my mind, that's not true asset allocation. You're limited to only two asset classes that have had, over the past few years, greater and greater correlation with each other. But many people would be happy with this kind of model, and they would simply turn passive once again. Once their advisor has allocated their assets, then they're willing to just go along for the ride. It's, once again, a passive strategy. So you don't want to be like this guy here who doesn't even know what he's got anymore and doesn't care. He's just floating down the stream. The good news is he does have some asset allocation. The bad news is there may or may not be a strategy behind it. And if that's all you're doing, you're just floating down the river one more time on that same raft, just with different logs. So what I want to talk about today is a unique product that I've talked about a lot the last couple of months because I'm really excited about it, and I'm going to keep talking about it because the more you understand about the power of active asset allocation, you'll appreciate more and more the Goldman Sachs Momentum Builder product. This has been around now for 3 or 4 months, and I've talked about it a lot. In fact, I've dedicated an entire webinar to it at one point. I'm inclined to do it again, but today I just want to talk about this particular product in the context of asset allocation, because this is something that you and your competitors haven't really had the opportunity to do before. This is a unique product diversified over 7 different asset classes. It utilizes momentum-based investing and modern portfolio theory in a mathematically based formula to generate consistent returns across 7 different asset classes. Just a quick refresher on what modern portfolio theory is. It's basically balancing risk and reward and reaching that efficient frontier where you've got the perfect balance between the risk the investor is taking and the return they're getting. An inefficient portfolio of investments is shown right here in the center. The modern portfolio theory looks to find the same risk but a higher return or the same return with less risk. The Momentum Builder product does this over 7 different asset classes, not just several different types of stocks. Look what we have here. There's a cash position for money market, developed market equity. So you've got exposure to the S&P 500, but also to some developed international stock exchanges. You've got U.S. bonds, short-term and long-term, high grade and and high yield. You've got exposure to emerging markets across the globe, and alternative investments as well, including senior loan portfolios and real estate, and of course exposure to commodities and in particular gold. So you really do have an asset allocation strategy here, and the strategy is active. It's not passive. It's not, plug it in and play and let everything happen the way the way that it usually does. This is an active strategy. Goes through several steps, and I'm not going to elaborate too much on this because just understanding that it's a dynamic process, ongoing on a monthly basis, is probably enough. But this fund is rebalanced every single month. Rebalanced every single month. And what they do is they test every possible portfolio combination of those 7 different asset classes, 14 different ETFs, and look at each and every single portfolio. Then they look back for 6 months, 3 months, and 1 month, and they take only those portfolios that they've created that have realized a volatility of 5% or less. So that eliminates the more volatile combinations of those asset classes that they could go into. And of the ones that remain, they choose the portfolio that had the highest 6-month realized historical return. This is a mathematical marvel, folks. You don't have to rely on a money manager to choose the most efficient combinations of 7 different asset classes as reflected by 14 ETFs. This is a marvelous, marvelous way for the average consumer to achieve true asset allocation, but without risk to principal and with the added security of FDIC insurance. The fund has actually done pretty well, and I put these numbers up before, but I think they're really worth noting. You can go all the way back to 2003 on this particular chart. This is something that we can do with this particular market link CD, because since everything is rules-based, since it's all mathematical, we can backtest, and we can look at what would have been historical returns for this product. And we can do it with confidence. All the way back to 2003, you notice the annualized return in 2003 was 22.47%. Well, I suggest that's probably an anomaly. It's not designed to do that. But by the same token, if you look through those annual returns, you'll find only one negative year in there out of all 10. And that was 2008, and we all know what was going on there. And by the way, would you have been okay with a minus 1.5% in 2008? Oh yeah, especially when the rest of the market was down 30, 40, and 50%. So this is a product that performs the way true asset allocation should perform. Steady, 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 steady. Low volatility, positive returns on a consistent basis. It's like, never striking out but never hitting a home run. That's diversification, that's asset allocation. Now, I want to go back to the traditional models real quick here for just a moment and make a point. You notice this particular section, this particular allocation model comes in three different flavors, from aggressive to moderate to conservative. Aggressive to moderate to conservative. And down at the bottom, they show what the returns would have been in their particular mix of stocks and bonds. And you see, of course, the more aggressive portfolio got the higher returns. The more conservative portfolio got the lowest returns, over those periods. And you have to ask yourself, if the asset allocation strategy is so sound here, why would you have three different flavors? Why would you have aggressive and then conservative? Well, it's obviously because the conservative investor can afford to take less risk than the aggressive investor can. But all of this becomes a moot point if your client is in the Goldman Sachs Momentum Builder multi-asset product. Because now they have diversification of 7 different asset classes, active allocation so that it's not a passive strategy, a guaranteed minimum annual return of 1% a year, guaranteed return of principal, and with FDIC insurance. A sound mathematically based strategy, diversified over 7 different asset classes, with a minimum guarantee and FDIC insurance. What's not to like? Folks, I've said it before, this is the future of investing. This is the future of investing. And you have this product available to you. If you haven't taken a close look at it so far, I urge you to go into the agent portal section of our website, pull up the disclosure documents, pull up the term sheets, and take a close look at this product. I think you'll really be excited by what you see. Okay, as always, I'm willing to take questions here at the end, so if you have questions, please feel free to type them into the chat box, and I will be happy to respond to as many of those questions as we have time for. I don't see anything in there yet, so I'm going to hang on for just a moment and see if any questions do pop up, and we will respond to them. Fred asks, hey, what's your website again? It's www.adisusa.net. That's www.adis, as in Alternative Design Insurance Services, USA.net. And of course, once you're there, you'll want to go into the agent portal, and you'll find all of the documentation there. The 2-page term sheets as well as the full disclosure documents. And if you haven't taken a close look at the Goldman Sachs Momentum Builder, this would be a good time to do so. It's an absolutely fabulous product. I think it will eventually revolutionize the way people think about investing and diversifying in the future. Shell asks, is there a minimum hold period? The direct answer to that question, Shell, is no. It has a maturity date of 7 years. The product is liquid, meaning you can get out of it at any time without a surrender charge and without a penalty. However, if you choose to get out of the CD prior to maturity, there is no guarantee that you'll receive back 100% of your original principal. The way the process works is you redeem it or sell it back to the bank for whatever the current market value is. And that current market value could be less or more than the initial principal amount. So yes, you can get out at any time, but you do so at the risk of losing some principal. If held to maturity, of course, 100% of the principal is guaranteed. David asks, can we get the rebalancing and index reporting? Looks like, I think you meant cheat sheet. Yeah, I can make all of these things available to you. You can find them generally online. If you'll just Google Goldman Sachs Momentum Builder Series, there's a lot of this stuff will pop up immediately. But if you have something specific, please be sure and ask your business consultant, and we'll make sure that we get you what you're looking for. Michael asks, would an investor have seen the negative 1.45 return on their annual statement? Seems like this would create some concerns with regular CD investors. Michael, that's a great question, and the answer is it's never taken out of principal. So what they see on their statement is always 100% of their initial investment. Their CD is held at par. So if they put $100,000 in, even in a year when there's a negative 1.5 on the interest crediting, they would still have $100,000 in the CD, and instead of suffering a negative, that would kick in the minimum guaranteed payment in that year of 1% positive. So good question. No, it wouldn't be reflected on their annual statement. Sam says, so no individual ownership of the assets, correct? And that is correct, Sam. This is a market-linked CD, not direct ownership. So it's linked to the Goldman Sachs Momentum Builder Index. And so there is no direct ownership of the assets in question. The return is simply calculated by the performance of those assets as represented in the 14 different ETFs and a money market account. Good questions today. Michael says, just for clarification, so investors would have seen a 1% positive gain for the negative year. The answer is yes, Michael. Yeah, that would have. The interest calculation simply came out to a negative number. That means the minimum guaranteed rate would kick in, and that's 1%. So yes. Jim asks, does this particular CD pay interest annually? And the answer is yes, Jim, it does. The investor receives the returns every year. Interesting calculation methodology that you might be unfamiliar with. I call it annualized point-to-point. If you're not familiar with it, or if it doesn't make sense when you read the disclosure documents, be sure and give us a call, and one of the consultants here will walk you through it. It's really pretty simple once you get your arms around it, and there are good reasons for it, but you probably haven't seen it in an FIA so far. So yes, but it does pay annual interest. Viva asks, where is the money actually put by the Provident Fund, if not directly into these companies or banks? Good question. Provident doesn't do anything with the money. They purchase the CDs from the banks and hold electronic evidence of it for the benefit of the client. So the bank has the money. What the bank does is it purchases a certain number of U.S. government bonds, which will, at maturity, be sufficient to return 100% of the principal to the CD investors. They take the balance of the money and purchase options on various portfolios, either the index or, in this case, the 14 different ETF funds based on the mathematical formula, and the performance of those options is what determines the outcome of as far as the bank is concerned. Okay, it looks like that is going to be it for questions today. Once again, I appreciate you taking the time to dial in today. I'll be back next week Same time, same place, 11:35 Pacific time, right here. Thanks for dialing in. We'll see you next time. Until then, have a great week.